time for the MF Corner, and steady income and growth together is a dream for any investor. Let's chat a little bit more with Dhirendra Kumar of Value Research on whether or not one can turn that into a reality. Dhirendra, how can one construct a portfolio that gives income as well as growth?
The rationale here for this portfolio is that it should be used as a, most people who invest in the guaranteed return savings, they are not able to beat inflation. So this portfolio is planned as a supplementary income portfolio. You should not be depending on this portfolio for regular income, but you should be one should expect a decent income, and your capital should be protected from inflation. That is why this portfolio ends up being about 40% into equity, 30% and remaining in fixed income. And this is planned as a lump sum investment. Most all other portfolios that we run, that is they are all accumulative portfolio where you are doing your SIP into a couple of funds. But this is something which is planned as a portfolio where you can make lump sum investment, and it is built with the hybrids. It has planned as a low maintenance portfolio to derive supplementary income, and so that your capital is protected from inflation.
Dhirendra, what kind of investors is this portfolio best suited for, and what kind of time horizon should one have in mind?
It is meant for people in retirement, and people in retirement who have been, who do not depend on their investment. This is a portfolio from which you should not be depending for regular income, regular monthly income for your normal expenses, but incremental investment from which you want to derive some superior return and protecting your capital. So people in retirement making lump sum investment for additional income.
Our first query, Dhirendra, is coming in from R.R. Chandra, and he wants you to explain the tax implication of switching in debt income funds from a regular plan to a direct plan after the exit load becomes nil.
The tax implication is pretty straightforward. You're moving your money from regular plan to direct plan will be considered as a redemption and a new investment. So there is a possibility of investments of over, less than 1 year will be added to your income in a debt fund, any appreciation. So it will be treated as normal income. So ideally, even if you have crossed the basic threshold of exit load, still I would suggest that if it is your long-term investment in a debt fund, wait for at least 1 year so that it is treated as a long-term capital gains, and it is and you are liable for taxes concessionally.
Right. The second query is coming from Nirav Gilani. He wants to know if it's a good time to invest in bond funds given that the interest rate cycle is reversing.
Yes, for it looks like it's a good time to be investing in bond funds, and if you are trying to benefit from the rate cuts, then I would suggest that don't try to get very aggressive with this. Don't try to actively time it. Choose 1 or 2 dynamic bond funds. These are funds which can actually move their maturity over, in a broad spectrum. They can go very long, and they can also, maintain a very short maturity portfolio. And the fund manager's discretion will be helpful. So consider 1 or 2 dynamic bond fund, invest in that. Don't try to time it perfectly.